for the very first online session of the Masterclass series at the Office of Interdisciplinary Studies, that is IDEAS, at OP Jindal Global University. IDEAS is a university-wide platform committed to fostering interdisciplinary research, innovative teaching, and collaborative scholarship across and beyond the many schools and institutes of JGU. At its heart lies a belief that today's most pressing challenges demand ideas and solutions that cut across disciplinary boundaries. The office's flagship program, that is MSc in Development Practice, has been conceptualized and designed to equip students with the tools and perspectives needed to engage with the complex, interconnected crises that shape life in the global south, ranging from, say, climate change, jobless growth, to deepening inequality, and much more. It combines rigorous theoretical training with intensive field-based learning, preparing students for meaningful careers in development research, policy making, and social practice. Our Masterclass series is a core part of this vision. Each week, we invite leading scholars, practitioners, and policymakers from India and across the world to share their experiences and help bridge the gap between classroom learning and the lived realities of development work. These sessions are not only an opportunity to learn from some of the most distinguished voices in the world, but also a space for dialogue, debate, and critical reflection on what development really means in different contexts. Today, we have with us Dr. Maanik Nath, Assistant Professor in Economic History at Utrecht University. His expertise lies in Asian economic history. His ongoing research explores a range of topics, including climate and agriculture, financial markets, law and institutional change, collective action, and political representation, as well as health and living standards. His work seeks to explain the determinants of development in the developing world. In today's session, he'll be discussing his very insightful book titled Capital Shortage, Credit and Indian Economic Development, 1920 to 1960, that brings together economic theory and historical evidence to provide an authoritative account of the interactions between climate, law, policy design, and economic development. So basically, Dr. Maanik will be speaking for, say, about 35 to 40 minutes, following which we'll be inviting our two discussants, Dr. Rohit Jyotish and Dr. Nayan Jyoti, to share the remarks and reflections on the book. Dr. Rohit Jyotish is an assistant professor at the Jindal School of International Affairs. He's a political economist with research interests in public finance, political economy, and labor studies. Dr. Nayan Jyoti is an assistant director and lecturer at IDEAS. He's a social anthropologist working on global value chains, automation, precarity, cultural production, and subjectivities. With that, I hand over the mic, so to say, to Dr. Maanik. Dr. Maanik, please go ahead, and many thanks for joining us today.
Yeah, thank you very much for a very generous introduction. I'm really delighted to be here, and also very excited to see this initiative of interdisciplinarity. Very, very exciting indeed. I won't say a lot apart from just try to share my screen so I can try to fit in what I need to do in the 35 to 40 minutes that I have. I'm not especially well known for punctuality, but I'm going to try very hard today to be as punctual as I can possibly be. I'm assuming that people can now see this presentation. Yes, perfect. Okay. Okay, so as kind of introduced, I'm going to be talking about my book today. This book was published by Cambridge University Press 2 years ago now. And it felt like it took a lifetime of work, and I feel like I've actually been able to live my life a little bit more over the last couple of years. But really, the main kind of driver of this book, at the heart of this book, are kind of two big questions. The first question is really one that is at the heart of my field, which is economic history, which is why were some regions economically underdeveloped? What I do in this book is I ask, why were some regions financially and economically underdeveloped? And it is really this link between kind of financial development and economic development that I think is something that I explore quite a lot in the book. And I think it's also at the heart of Indian economic history and Indian rural development more generally. And I'll hopefully be able to convince you of some of that over the course of this talk. And the second question is kind of the setting of my book, which was why was India poor and unequal between 1850 and 1960? There are two things to mention in this question. The first is I don't just take for granted that India was poor and unequal. That is a vast kind of literature and economic history that says so, and I'll talk about that. And the second is, you'll notice the dates, a starting date of 1850 kind of makes sense. 1960 kind of transcends the boundary of colonial rule a little bit. So the British left India in 1947, and I extend this to 1960 for a specific reason, which is that 1960 was the start of the Green Revolution. It was really the change in the transition in the Indian agricultural economy, and I want to look at what that economy looked like before that change. I do also touch in the book. I've been told many times that I think I've been too modest in my time period in my book. I probably could have extended it a little bit more. And I do have a chapter in the book where I talk a little bit about what happens after 1960 as well. So I'll bring that into the discussion in my talk here. I add a third question here for this interdisciplinary audience and for any students out there, which is, can the past help us understand patterns of development in the present? So if I can be an ambassador for economic history today, apart from just talking about my book, that might be a question that might be kind of coming up as and when we talk about this. This is not just a book about trying to hopefully think about history, but it's also a book about thinking about what history can tell us about the current reality. Okay, so that's the cover of my book. And really what the book does is it explores unexplored court records and data from government reports, and more importantly, surveys that were taken from the early to mid 20th century of villages in India, and they're largely unexplored. And that's something that I tap into to inform my analysis. I look at the villages and districts of a major Indian province, which is the Madras province. And that's something that I'm going to talk about in a second. And the approach that I take, and I think one of the things that I wanted to do with this book was not just to think about what the history was, but to start to construct a framework to understand this problem of credit and development that is adaptable across regional and historical settings. So is there a way for us to think about this concept of financial and economic development, not just in the Indian context or not just in the Madras context, but across, say, the global South? And the argument that I make in the book is that a tripartite set of risks, including climate, law, and political objectives, constrained capital markets, private investment, and rural development. And I'll elaborate on each of these tripartite risks. I'll elaborate on climate, law, and political objectives over the course of this talk. So the setting. So this is what the map of colonial India looks like. If you kind of haven't seen this before, looks very different to a map of modern day India for many, many reasons. One of them being, of course, that it included a much larger region than just India. See, British India, of course, included Pakistan, Bangladesh, and parts of Eastern India, parts of what would be now, Bangladesh, but also technically Burma, though we don't really talk about Burma when we talk about British India. Maybe we should. But the map that I look at here includes kind of what was directly governed by the British. So that is the parts of these provinces that were unshaded. The shaded parts were the princely states, what were ruled by kind of Indian dynastic rulers. But over the course of colonial rule, a lot of them became indirectly ruled by the British in many ways. Though, sadly for the historian, we don't know a lot about what went on in the princely states, partly because the archival sources are either small or partly don't exist. There have been some archives that have opened in India recently that have got some interesting documents on the princely states, and work to digitize some of that material and to look into it is still ongoing. But a lot of what you see about the economic history of India will technically be about the provinces, usually be about the provinces that were directly governed by the British. So the unshaded parts here. The province that I look at is the Madras province. So you see that in the south. And it extended essentially from the southern tip of India all the way up to what would be now the north of Orissa on the east. It also extended on the west up to what would be now Karnataka. So it encapsulated something like parts of what would be now 6 Indian states. It had a kind of surface area of about 48,500 square kilometers. When I talk about the period after 1947, I look at this province as it was, so I will then start looking at the different states as well for the 10 or 15 years after independence, after colonial rule ended. Okay. So one of the big kind of things that we know about British India, so that's even before I wrote this book, the big picture of colonial rule is that the Indian economy stagnated during British rule. That's a story that we know. A major part of that stagnation was agricultural stagnation. That is, the rural sector really did not grow. If I was to put up a graph here of GDP growth in agricultural India from, say, 1860 to 1950, which is data that we actually have, it would show a pretty flat line, something like 0.8% average per year. A lot of that growth was concentrated between kind of 1860 and 1900. After 1900, really, the curve flattens. We don't see a lot of growth. What I like to do, though, is to look at this graph here, which is the annual rate of change in agricultural output between 1886 and 1940, I believe that is. So what this graph is basically measuring is year on year, how much did agricultural output change? Anything above 1 would be a positive growth in output. Anything below 1 would be negative growth. And what this basically shows you is the volatility of the agricultural sector. So you have these years of bumper crops. You have the year of, the early 1890s, early 1920s, where you had bumper crops. And then you have years of significant negative growth. So the 1919 kind of pops out there with a very large decline. In some districts, or in actually quite a few districts, lost something like 90% of their expected crop output in that year. So these are significant changes. One of the issues with this is how, if you were a farmer in British India during this period, what do you do to manage your exposure to this volatility? That becomes a very, very big problem. And amidst that, what economic theory would actually tell us is that credit is actually essential in that problem. What credit does is it's a source of survival. When you have that year where you have lost 90% of expected crop, which many did, you needed to borrow to survive. You also needed to borrow to invest. If you are being kind of exposed to large volatilities, budgeting for volatility becomes very difficult. So how do you kind of decide to make private investments amidst that? But you also need to make a private investment, either shift your cropping patterns, buy new seeds, build a well, all these different things that can help you protect against some of this volatility. And to do that, you really needed credit. So credit becomes kind of essential to this rural economy. And that's the starting point, really, for my book. So what did the credit market look like? Well, there were a few changes in the 19th century. I mean, one thing that doesn't change is that moneylenders control the supply of credit. So there were joint stock banks, the emergence of commercial banks and investment banks in British India. They did not enter the agricultural sector at all. And a part of that was because it was very risky to do so. So moneylenders controlled the supply of credit. What happens in the 19th century, partly with the spread of the railways and the connected kind of growing connectedness of the Indian hinterland to the ports and to global markets, is you see the spread of urban community lending networks to agrarian India. So you see kind of Marwari bankers who operated a lot in the cities start going out into the rural areas and lending there. And a lot of these lenders kind of functioned as banks. They held deposits and supplied loans and kind of were a multifunction unit. In the South, a big kind of lending community, a big lending network there was the Chettiar bankers. So these network of Chettiar lenders who operated a lot in the cities moved into the countryside in the 1870s and 1880s, actually a little bit earlier, 1850s and 1860s, and were lending quite aggressively in rural India for a short time. And I need to emphasize this short time because a lot of that changes in the 1880s for a few reasons. One is we know that a lot of these lenders exited the market in a very specific time frame across India, not just in the South. And two reasons pushed that. The first was default rates were very high. So a lot of these lenders started to report that it was very difficult for them to recover the loans that they were providing. And the second was that land alienation laws, which is the government started to introduce legislation that restricted the transfer of land from agriculturalists or farmers, basically, to urban lenders, which meant that land could not really be used as collateral anymore if you were an urban banker. So that pushed the lenders out as well. And what happened out of that was that farmers themselves then became the dominant money lenders everywhere. So if you were a farmer and you had disposable income, you were lending it out to your neighbors, to other people in your village, sometimes to people in other villages as well. And that structure becomes typical across rural India, particularly by the 1900s. And there's a really important aspect to that structure, which is if you are a farmer, then you are taking on a dual risk. You are not just taking on the risk of your exposure to volatility, output volatility of your own agricultural business, but you're also taking on the risk of providing a loan and not recovering it to someone else in your village or nearby villages. But that becomes typical of the rural economy in India from the 1880s, 1890s onwards. Because this market was sort of informal in a way, but it was also very competitive. I mean, it wasn't just one person lending in a whole village. Anybody with disposable income or with income to spare was lending across villages. You could have kind of 3 to 4 lenders per village. That was common. You could also see 30 to 40 in some, and that's in the south. If you go to some parts of, rice growing areas in Bengal, you could see even more than 40 in a village. Anybody with disposable income was lending. So what were they lending to? What was the nature of agriculture? So this was a map that was created or drawn by a British meteorologist in the early 1900s. And he really wanted to try to understand the nature of tropicality. What was one of the things that perplexed the British a lot, British administrators, was this nature of kind of how different the kind of climate setting in India was relative to what they knew. And a big part of that was seasonality. So they tried to basically understand the monsoons. The feature of Indian agriculture that, persists today, which is that for 6 months of the year in a lot of India, you cannot grow anything because it's too hot and too dry. And that's a big part of the nature of agriculture. Now it's a little bit different, of course, because irrigation investment has been so pervasive. At the time, where a lot of Indian agriculture was rain-fed, you basically relied on the monsoon to grow anything. And depending where you were in India, you could either have a season that was 2 or 3 months long in a whole year. You could also have a season that was 5 to 7 months long. And that was kind of the more, the delta regions, what would be now the southeast. So the Godavari Delta, for instance, or the Tanjore Delta, you would have a slightly longer season. The Indian hinterland, you'd have a very short season. The other aspect that was interesting about it wasn't just that you had a short season, you also had less rain, but you also had a lot of volatility. So where you have a season that's only 2 or 3 months long, so that's the Indian hinterland in particular, any kind of shortage of rainfall affected you a lot more because you did not have another season to insure against it. If you had 2 seasons, so that is, the more wet parts of rural India, then you have 1 bad season, you could have another one that insured against it. If the southwest monsoon failed, the northeast could have been in insurance. And that was a major part of it. So you start to see these very distinct climatic zones emerge in colonial India, but also the way that agriculture was conducted. For the Madras province, you basically have and I'm not the first to come up with this. Chris Baker, David Washbrook, other economic and social historians have looked at agriculture in colonial India, have talked about these distinct zones. So you have the wet zone, which is where you had longer seasons, more rainfall, and slightly less volatility. So that's what would be kind of in these blue boxes here. And then you had these arid zones, where you had very little rainfall in a very short season and more volatility. To give you an idea of what this kind of looked like in the colonial period, in Tanjore, you might get something like, I don't know, typically 50 to 60 inches of rain in a year. In Bellary, you'd probably see about 10 to 12. And that was typical. So these are quite vast differences in the nature of this agricultural climatic areas. So that affected the credit market. And this is the kind of the starting point. My first kind of really dive into the credit market in my book is really to show that the credit market operated differently in these zones. partly because the risk was very different. The risk of default was a lot higher in these arid zones where the risk of crop failure was also very, very high. And the wet zones where the risk of crop failure was lower, you had a kind of slightly different credit market that emerged. And it basically emerged differently because money lenders were strategic. So in the arid areas, they would lend very strategically. They would lend to the farmers with larger bits of land who could insure against some of that volatility. The smallholders, the tenants, and the laborers were really excluded from the credit market in the arid areas. In the wet areas, you see a slightly more inclusive market, more suppliers, more lenders, and more people being able to access this credit. And the other way to think about this is just high-risk borrowers were really excluded. That was really a big part of the credit market. And this creates kind of this cycle that really perpetuated across colonial and early post-colonial India, which is risk, that is climate risk, led to credit exclusion and low investment. And that cycle just does not break throughout this entire colonial period. And one of the things I show in my book is that actually for a lot of people, they're still stuck in this cycle. And that's kind of something that's perpetuated in the long run, I think. Okay, so how do I do this? I'll just give you a kind of, there's lots of ways that I do this in the book, but I'll give you a snapshot of how I kind of interpret the sources. So this is kind of from a village survey in 1935, which surveyed credit markets across 141 villages in the South, across different districts. And what it basically does is tell you a bunch of data about lots of different things. One is the lending per village, so how much was provided, the number of borrowers per the number of households. So of the number of households in a village, how many were borrowing? The number of borrowers per lender. So what was the size of this lending business? You know, how many people were being lent to? And the debt per borrower. So on average, how much were people borrowing? And really interesting things popped up for me. So if you look at the Bellary district, so that's just a kind of representative of a kind of very arid district in colonial Madras, you see a lot less being provided per village. So there's less lending. You see far fewer borrowers. So, you know, only 40% of households borrowed. You see far fewer borrowers per lender. So the lenders were lending to very few people at a time. But the debt per borrower was much, much higher than anywhere else. So essentially what that's telling you is that there's very few people being able to borrow. And the ones that are borrowing are able to borrow a lot. So if I match that to some of the narrative sources that I read at the time, it's essentially that in places like Bellary, you really only have the wealthy that can borrow. In a place like Tanjore, you have 80% of households borrowing, and the amount that they are borrowing is a lot less on average. So anybody was really able to borrow in Tanjore. Not many were able to borrow in Bellary. So that's kind of telling you how this credit rationing, as we call it in economics, was really taking place. The other is if we look at the number of mortgage registrations, and essentially what you see here is, again, you know, and in the book, I talk about a lot more districts, but for the sake of this, I'll just, you know, use this Tanjore Bellary comparison to kind of show you what I find is that in places like Bellary, you see kind of the average mortgage registration being far, far lower, either number of mortgages or in the value of those mortgages than Tanjore. But the average value of each mortgage registration was much higher in Bellary than in Tanjore. So again, it's just corroborating this table that I've got here, which is fewer people are able to borrow, but the ones that are borrowing are likely to have been a lot wealthier in the arid areas, that is. Okay, so what economic theory, I mean, when I was kind of writing this book, I looked at some of the kind of what development economists were writing between, say, the 1970s and today, and a lot of that literature kind of tells us that, well, law can mitigate this problem. So you have climate risk, you have this what's called exogenous risk, but law or property rights or the legal system, contracts can try to help borrowers mitigate that problem and then borrow. So did that happen in colonial India? So that's a picture of the Madras High Court from the 1930s. And essentially what the British do when they arrive is they start to create a legal system that sort of mimicked what existed in Britain at the time. So that is, you know, appellate courts, a hierarchy of courts, tried to create a uniformity in contract law, a uniformity in kind of the laws that regulated negotiable instruments, the sort of contracts that we use in the rural areas. And so by the early 1900s, you had kind of village courts, district courts, the High Court, what would kind of look like the modern legal system in India. And across those courts, credit disputes were something like 80 to 90% of all civil disputes. it starts to become a very, very disputed, or not started, it was always a very disputed market. What ends up happening with the enforcement of these laws is there starts to become a confusion between this legal uniformity, what the Britain was trying to kind of achieve, and the diversity of Indian contracts. You did not have one type of contract that was kind of existed across rural India, and not even across rural Madras, not even across a single rural district. You had different versions of contracts that were being used, and the ability for the law to regulate that created a lot of confusion in these courts. And that created significant delays in the Indian legal system. So there are books now that have come out recently about legal and economic history in British India that kind of talk more about this. But there were a lot of inconsistencies and delays in these rural courts, the civil courts in particular, from around the 1880s. And by the early 1900s, this led to a lot of costs. So if you were a lender or a borrower and you were disputing, kind of litigating in a court, you incurred a significant cost. This is an example of a type of contract. This was a promissory note from 1920s Madras. Sadly, the source doesn't say which district it came from, but broadly, it's sort of, so you see the Tamil at the top, and then at the bottom, the English translation. This was not necessarily pervasive. So this is just a type of contract, a type of promissory note that was taken to a court. And it basically mentioned, the names of the borrowers and the lenders. It talked about the amount that was borrowed, the interest that was charged, and when the repayment, the maturity of the contract, essentially, and usually witnessed or attested by people in the village, usually a school teacher or an accountant, someone like that. What the credit market looked like was, because enforcing a contract like this was so expensive in these courts, was these loans often started off as unsecured. So moneylenders would provide a loan and expect repayment. If the loan was not repaid, it was upgraded to a contract such as this one, a promissory note, after a round of default or 2 rounds of default. And then eventually, if that compounded, then it would be upgraded to a mortgage registration, which was the most expensive form of contract in British India. The cost of enforcing these contracts went up with each round, and that's an important point. And so really, these lenders and borrowers really only used courts as a last resort. When there was defaults that were very high, either because your harvest failed or because there was some sort of crisis, then these courts became very congested because all these lenders and borrowers were litigating in these courts over these credit disputes. In good years, the courts were less congested and the contracts remained kind of unsecured. Okay. For the courts, now if I was to kind of look at this from the perspective of the courts, this was a big problem. For the judges who were sitting in these courts, the question was, who did the court protect when contract liability was weather dependent? In the classic kind of credit default situation, the contracts were designed to prevent borrowers from willfully defaulting on loans, that is, taking a sum of money and running away with it. That was not the case in British India. When contracts failed, it was because the harvest failed. But then who does the court protect when contract liability was weather dependent? Became a question in the courts in the 1880s. Well, they first protected lenders in the 50s to 70s, so that resembled, they had kind of debtors' prisons, things like that existed in Britain. And the borrowers immediately rioted, as you'd expect. So, well, we didn't default willfully. So then the court started to protect borrowers, and they started to cite acts of God. So this is kind of from the 1870s, 1880s, you start to see the phrase acts of God emerge across legal disputes ubiquitously. There's, judges telling lenders, I'm sorry, we need to think about a way to readjust the terms of this contract because the borrower has not repaid the loan due to an act of God. And there's something that we need to do to adjust for. So that's, seems like a logical step, but it created further confusion in this litigation, and it increased the length of these disputes significantly. So if one of us, if I was to transact a credit amount with somebody here, and I defaulted, and you took me to a court, the village court and a district court and a high court, the average length of that dispute would be something like 5 to 8 years by 1900. By 1920, that becomes 10 to 12 years. The cost incurred for litigating that was something like 2 to 3 times an average loan amount for a wealthy farmer. For a poor farmer, it was significantly higher. The other thing to keep in mind was a lot of these credit transactions were seasonal. People would provide a loan in in June, something like that, and expect repayment in January. So a 7 to 8 year court dispute for a loan maturity of 7 months was really problematic and added to this kind of expense. So what the lenders did was they priced this high cost of credit into their interest rates. And they also further exacerbated the problem. So the poor found it harder and harder to access credit, partly because the cost of enforcement was so high. And all of this comes to a fall in the 1930s. So as you would expect, kind of the Great Depression, one of the largest financial crises, or most significant financial crises of the 20th century, also affected rural India in a dramatic scale. You know, its exposure to the global markets through its export of cash crops, but also through kind of significant deflation. And so trade falls, the prices fall through this deflationary period. And the result of that was that debt obligations ballooned. So the average amount that people had to repay really exploded at this time. This is a survey from the 1930s that talks about why people might have borrowed. So it looks at kind of, I can't remember, I think it was like 80 or 90,000 households, the early 1930s, says, why did people borrow? And in this period of time, the main purpose of borrowing was to actually repay an old debt. So you see this black line there was the borrowing to discharge an old debt. The gray line was any other cause, all other causes combined. And so a significant portion of borrowing at this time was to actually repay defaulted loans, to tell you how high default rates were in the 1930s. And so political actors at the time started to call for borrower protection. So what we need to do here is start to protect these borrowers who are really highly leveraged on the credit market. And so the 1935 Government of India Act, which kind of came after the Great Depression, delegated credit policy to the local legislature. And then the Madras Legislative Assembly, there was kind of significant debates on the ideal version of borrower protection. So they were like, how do we protect these borrowers? In 1936, or 1937, actually, the Indian National Congress won the local provincial election in Madras and ran on the platform of borrower protection. And essentially, they enforced immediately, soon after they won this election, the Madras Agriculturist Relief Act, which was a law that restricted interest rates to 6.25% per annum, which, to put in perspective, was about a third or fifth of the market rate. So a moneylender would normally charge something like, if you were a wealthy, low-risk borrower, maybe 12% per annum. If you were a not so wealthy, high-risk borrower, something like 24% per annum. So this was a significant reduction. And the way that it was enforced was through the courts. So what the Legislative Assembly said was, to the judges, was every time a credit dispute emerges in front of you, make sure the interest rate is capped at 6%. And so what you'd expect to happen happened, which is the lenders just went underground. They stopped lending. So this is kind of the average value, real value of mortgage loans. So that is the value of loans adjusted for inflation. Between 1936 and 1940, they declined by something like 20 to 40% everywhere. It becomes harder to access credit, in other words. We also stopped seeing people go to courts. As you could imagine, the lenders say, well, you know what? If I do provide credit, I'm not going to take you to court anymore because I want to charge you a higher rate. So the number of court disputes also declined significantly in the 30s and 40s. And so there's a few things to kind of reflect on here. One is that, you know, what was written at the time in a newspaper article in the 1940s was that the Agricultural Relief Act drove out the honest lender. And all this lending activity starts to go underground. There starts to become a kind of alternative market for loans that becomes unregulated. So, you know, paradoxically, a law that was intended to regulate the market actually makes it further unregulated. And that was kind of an unintended consequence of it. You start to see a huge decline in all contracts, promissory notes, mortgages, all of it, and a huge increase in kind of informal arrangements, things like sharecropping, where lenders would provide loans on the back of taking a percentage of the borrower's crop. That starts to become a lot more common in the 1940s. Interest rates remained high or even increased to adjust for these changes in contracts. And the bottom line is that it became much harder to access credit, especially for the poor. The high-risk borrowers start to make it becomes even harder for them to really access the capital market after 1937. So for the government, you know, credit became a source of inequity in rural India. And that's something that's not new. That's something that existed for a long time. But this narrative, the powerful moneylender and the vulnerable borrower, became the dominant narrative. And that starts in the 1870s, 1880s. And across these periods of crisis in the early 20th century, that heightens. For the British policymaker, the narrative becomes the powerful moneylender and the indolent borrower. That is, the illiterate borrower who doesn't understand the nature of a contract. For the Indian policymaker, it becomes the vulnerable borrower. That is the capture of borrower's power through kind of powerful monopolistic lenders. And so when they tried to discipline lenders and it did not have this intended consequence, they started to think, well, are there other things that kind of we could do? And what they then decided to do was to say, can we install an alternative to the moneylender? Banks do not want to enter the countryside, but are there ways of kind of other forms of credit enterprise that could compete with these moneylenders? And so in the late 19th century already, they sent this man, Frederick Nicholson, who was a senior colonial administrator in Madras, to Europe. And they say, could you find out how credit markets function there? Are there ways to borrow outside of banks and moneylenders? And so Nicholson goes in the 1880s to Germany and the Netherlands, parts of Eastern Europe as well, and then compiles a report called the Nicholson Report in the early 1890s. And he ends that report famously with the phrase, find Raiffeisen. And Raiffeisen was essentially a type of cooperative that existed in Germany, where people would deposit their savings in this cooperative, and those savings would be distributed across people in the village. And it functioned as a kind of risk-sharing mechanism. He proposed that to install that in British India, and he proposed it as a banking initiative. He said, what we need to do is to make sure that these cooperatives allow for collective risk sharing, that they are really bottom up, that they're formed by farmers themselves, are saved in by farmers themselves, and then lent to by farmers themselves. And the idea of it being self-funded will allow for mutual supervision. So that is, the government would have to do very little, because if people have deposited in this cooperative, they would care a lot about recovering money for it and would know who to lend to. So we don't have to worry about it. That was his model. And that's really the Raiffeisen model that existed in Germany. When this was implemented in the early 1900s, Nicholson was excluded, and the government took significant control of this cooperative installation. So unlike in parts of Europe and in British India, the cooperative was actually introduced as a quasi-public institution. So it was introduced through law. The 1904 Cooperative Societies Act was the first to actually introduce a cooperative into India, or at least a regulated cooperative into India. And the system worked differently than what Nicholson imagined. It was that government agents actually were responsible for not just registering cooperatives, but also managing them. And that was done in different ways. Every single provincial government in British India had a cooperatives department from the early 1900s, who then would allocate the management of individual cooperatives to their agents in these different villages and districts. And that was a very big departure from kind of how the model worked elsewhere. In Madras, a big figure for the cooperative, well, now it's called the cooperative movement, was Raja Gopalacharya, who I imagine everybody in this virtual room would know, and actually started his political career being a big voice for cooperatives in Madras. And one of the things that he was kind of keen on was to ensure that the cooperatives were actually heavily, heavily regulated, because he did not trust that the market, or in this case, the powerful moneylenders would actually take control of these cooperatives unless they were all regulated. And so the government had significant control over it. Were they financially inclusive? Well, the first thing is that from the 1910s, because there was low deposits in these cooperatives, public money starts to flow into them. So the government starts pushing a lot of taxpayer money into cooperatives from the 1910s. After 1950, this financial dependency exacerbates enormously. In financial terms, essentially what you're looking at here is an embedded moral hazard, because you have a system where taxpayer money is flowing into the system, and the system is kind of functioning without any sort of external regulation, and functioning kind of largely through political interest. So you see kind of the value of savings, the ratio of savings to total working capital in these cooperatives in the early to mid 20th century, and they're basically very, very low, something like 5 to 7%. The large majority, something like 70 to 80% of capital flowing into cooperatives was public money. The outcome of that was that credit supply expands across these villages, but access remained very, very selective. So it's not really functioning as a bottom-up risk-sharing institution It's functioning more as a kind of nationalized bank, as it were. Okay, so what happens after 1960? After 1960, the state takes a lot of control over the rural agrarian sphere, and credit expansion does occur at a massive scale. And a lot of that comes from cooperatives, also from nationalized banks and microfinance institutions. That, of course, is a lot later. And a lot of this credit finances the Green Revolution. That is the huge expansion in agricultural infrastructure that changes kind of agriculture from a kind of low productivity regime to a very high productivity regime across rural India. But default rates remain quite high initially. So the banks and these cooperatives and these institutions start lending very selectively. Financial inclusion doesn't really occur across rural India for a very, very long time. In the 1990s and early 2000s, if you open a World Bank report in the early 2000s, you see this kind of euphoria about microfinance, right? So this idea that microfinance is the solution to this problem, it's actually providing credit to everybody, and kind of praising it. And of course, after 2010, the major crisis in Andhra Pradesh, we start to spotlight the kind of harsh terms that are actually offered by these microfinance institutions. And in the book, I actually talk about how those terms offered by these MFIs in the early 2000s weren't a lot different from the terms offered by moneylenders in the 1920s. They're very similar. Similarly high rates of interest, similarly short contracts, similar nature of unsecured and contracted enforcement. And interestingly, the major response to the 2010 crisis was microfinance regulation, and a major part of that regulation was an interest rate ceiling. So you start to see a kind of familiar response to a very persistent problem. Okay, so I can't look at the time, but I hope I'm somewhat on time. Just a few lessons for you to round up. The first is that financial underdevelopment led to economic underdevelopment in colonial and early post-colonial India. And that's a major part of my story. That, high risk coming out of the geography and climate risk in particular really affected credit access and private investment. You start to see credit rationing, careful selective supply of credit and very low investment, particularly in the arid areas and particularly amongst the poorer, for the low-income borrowers. Laws and political interests address market power, but not risk. So it tried to deal with the problem of exploitation, but it did not deal with the problem of risk. And that led to a kind of persistent cycle of exclusion and low investment. The courts stalled and led to kind of significant delays, and capital became harder and harder to access for the poor. And that problem, I say in the book, changes for some after 1960, but many remained kind of in that cycle, probably even until today. Okay, second batch of lessons, which is again coming back to that question that I asked at the start. What can the past tell us about the present? I think economic history, I'm hoping that the book kind of does this, helps us understand the root causes of development patterns in the present. That a lot of what we see today kind of has its roots in history. And that's not just patterns of development or inequality, but it's also patterns of climate risk in institutions. That modern day laws and policies have historical roots. What we think about as moneylenders and borrowers and the kind of, the popular narrative around some of these agents actually starts early kind of in the 19th century, and that's kind of persisted to today. And what I would suggest is that why colonial era institutions or narratives persisted or changed is really a field for open research, particularly for British India and India more generally. So, there has been some research to talk about what has persisted, but a lot has also changed, and we don't really know why some has persisted and some have changed. And that kind of is a field for development scholars perhaps to come in and kind of help us economic historians figure out. Thank you.
Thanks a lot, Dr. Maanik. It was, a lot of interesting insights in a rather short time window. You've stuck to the 35, 40 minutes thing that was initially floated. So yeah, you were rather punctual, I would say. I would now request our discussants, let's just open for discussion with our discussants. First, maybe Dr. Nayan Jyoti and then Dr. Rohit can come in. So Nayan, please go ahead.
Okay, thank you, Maanik. It's a fascinating book and a great presentation. I'm an anthropologist, so not very equipped to question economists or historians do we do that often. You do a fascinating interlinking history reading. I thought I'll just start with like two kind of questions rather than as comments. Rohit Jyotish can probably do more of that. Two kind of basic questions. One of a more general nature, because you take this, you have given some reasons of why you are doing this, but still, I mean, because there are students here as well, in terms of doing a periodization of when we do economic history as such, why do you choose this particular kind of period uh, from 1920s to 60s? You do say that general accounts of Indian economic history and national income estimates, that is one kind of a rationale. But since you bring in one of the interlinkages between climate law and political objectives, with the change from the colonial to the colonial post-colonial period, do we or do we not like see major changes in the periodization itself? That would be one. The other would be a very, I mean, I got very fascinated reading specifically this one of the lessons for the present from the past in terms of capital's constitutive outsides and how capital constantly creates its constitutive outsides. Uh, so, like this very neat and clean kind of division between banks vis-a-vis the co-ops and the money lending systems and so on. I mean, that is kind of complicated. You also do give some kind of commentary on like the issue of typologies of this sort, like for example between the formal and the informal even sectors, if I can call it right now, how it's done. So on that also, if you can just come in and and comment a little bit more on the issue of these typologies and yeah, and then the issues for it. So yeah, I just wanted to put these two initially as kind of questions. Maybe Rohit can take it forward from here, and then we can come back to other questions later on. Thank you.
Yeah. Okay, thanks, Nayan. And I would also say that thank you, Prachi and the Ideas team for inviting me to be a discussant for this book. I would start by saying that uh, Dr. Maanik Nath's book, it's, I mean, few works can manage to bridge economic theory and Indian history so effectively, because this book kind of takes on a very, what is often a peripheral concern, credit markets, and shows how central they were to Indian development from 1920 to 1960. So I'll start by maybe saying what my sense is of the central contribution of this book is. Uh, it the main claim that is being made in the book is that there is high cost and shortage of capital that has been driven by risks and enforcement costs, and that can explain persistent poverty better than simple stories of exploitation. So you have policies such as interest rate ceilings or cooperative promotion that often worsened this problem. And regulation also became part of the problem of market failure. And this is a bold intervention because it challenges Marxist readings that emphasize usury, semi-feudalism, and exploitation. And it aligns with the institutionalist traditions of Douglas North, Abner Grief, Daron Acemoglu, and with uh, Tirthankar Roy's effort to rethink Indian economic history through institutions rather than class struggle. So if I have to um, sort of maybe approach this as a critique to further the discussion, maybe I'll have three broad points. First is with regard to this dichotomy between capital shortage versus exploitation. So I'll start by acknowledging the strength, which I think all of us saw in the presentation itself. It's a very detailed reconstruction of lender behavior, and there is a lot of attention to pricing and enforcement. But then I think coming from a Marxist political economy background, I would say risk is not an abstract variable, it is socially produced. So, for instance, the book shows how lenders in Madras presidency adjusted interest rates based on enforcement costs. So, from an institutional lens, this looks like risk pricing. From a Marxist lens, it is the extraction of surplus from cultivators with no collateral. And when the marginal peasant has no collateral, that is not just an enforcement problem, that would be a class relation. So the fact that money lenders could oscillate between using courts or relying on social sanctions would illustrate this point, that their informational advantage and coercive power were embedded in local hierarchies and not simply that of market frictions, right? So say post-Keynesian and Marxist scholars like Amit Bhaduri to Utsa Patnaik have insisted that interest rates and usury were modes of surplus extraction and not just compensation for risk. And that very asymmetry of information in rural credit markets does come from relations of domination. So it'll be like um, who controls land records, who commands local power, who can mobilize coercion. So institutionalist accounts definitely clarifies the mechanics, but it does so, I feel, at the cost of or at the risk of depoliticizing the whole structure. My second point would be with regard to colonialism and the state. And again, the book is admirably nuanced about colonial taxation, law, and policy design. But institutional economics tends to treat these as exogenous design flaws. So a Marxist view would insist that they were endogenous to capitalist accumulation. So land revenue settlements, the neglect of irrigation, the pricing of railways, as you mentioned during your presentation, they were not just inefficient mistakes, but were mechanisms of extraction. And the book would has actually shown how railway freight rates privileged export crops over food grains, and that could be read as precisely this. A policy that appears inefficient for subsistence cultivators but efficient for colonial trade interests. And after 1947, what you can see that there is a very striking continuity in that cooperative banks designed without sufficient savings, interest ceilings that push lending underground, were all framed as equity driven inefficiencies. But a Marxist view would read them very differently as deliberate strategies of class management meant to prevent rural unrest while protecting agrarian elites. And the state was not a neutral rule enforcer that went wrong, but a class actor that is reproducing this hierarchy. And the account of cooperative banking in South India is also very telling in the book because it's modeled on European institutions, as you mentioned, and they lacked adequate savings bases. They were captured by rural elites, and they ended up excluding poorer peasants. So I would say this looks less like a failure of design than a reflection of entrenched power structures. I'll maybe have one more critique, which is related to the efficiency versus equity dimension that's been brought very prominently in the book. And I thought this was one of the most interesting parts of the book. But this itself is a conceptual import from neoclassical welfare economics. It presumes that efficiency is the natural benchmark that we should be looking at, that a Marxist perspective would ask, efficiency for whom? If money lenders can recover their costs and enforce contracts reliably, that is definitely efficient, but it is efficient in extracting surplus from the peasantry. So the deadweight loss that concerns policy economists may in fact be the redistributive mechanism that maintains elite power. So by framing the problem as efficiency versus equity, we might be risking how efficiency itself is a political construction. And the book notes that when interest rate ceilings were imposed, that lending went underground. And from an institutional frame, this is a distortion. From a Marxist frame, it shows how regulatory ceilings simply reshaped the mode of exploitation. Credit remained costly, and peasants continued to bear the burden. And I'll have maybe 1 or 2 minutes of a closing reflection, which is that this book exemplifies the strengths of institutional economic history, its attention to institutional design, transaction costs, and incentives that makes a very, very vivid story and quite concrete. But precisely because it does so, it also exposes certain limitations. Marxist political economy would insist that what appears as risk and costs are in fact outcomes of class relations. And to the credit of the book, it does attempt to respond a lot of this in multiple chapters. It also says that colonialism and post-colonial state policy cannot be understood as neutral misdesigns, but as class projects. That efficiency itself must be interrogated as a political category. And that's why the book is important. Not because one side of the debate wins, but because it kind of forces us to sharpen the boundaries between the two paradigms and perhaps to see whether they can ever be reconciled. And that's where I will end for now because of the time. Yeah.
Thanks, Rohit, and thanks, Nayan. It was pretty interesting. Yeah, the take, especially, yeah, Rohit, what you just mentioned. Maanik, would you like to respond to the remarks and reflections now, or would you also like to see if there's any more questions from the other participants? Like, how would you like to go about it?
Sure. I mean, I would love to hear from people, so maybe I'll keep my responses very, very short, so that maybe it gives people a chance to also ask questions. I just to say thank you very much also to the commentators for your very insightful comments and questions. Really appreciate it. I just Nine Jyoti asked a couple of questions that maybe I should answer, particularly because there are students here. So why do I do this periodization? Why this period? If you ask any historian, we'll say because the sources exist. So that's one element of it. But of course, there's a larger question here, which is it's a period of very contested Indian economic history, a period of very, very low growth, in a setting of kind of that has a lot of kind of rural tension, and that's something that I wanted to look at with a slightly different lens than what we have now. The transition from colonial to post-colonial, actually, a lot of what you see happening in the 1950s, 1960s, I mean, that process starts in the 1930s. The delegation of a lot of agricultural policy to local legislatures from 1930s starts to see that process really early on. So when we draw the line is not abundantly clear. 47 may not be the best line to actually draw if we're looking at the puzzle that I am looking at. Because a lot of those policies actually continue into that period after. The borders change, of course, states come in, other things happen, but the kind of focus on how to regulate credit markets doesn't change that much in that period. That happens after 1960, partly because of the Green Revolution. So that's kind of my justification for that. The typologies of formal and informal, I think that's absolutely right. I mean, one of the things that I want to do in this book is to say that how economists and others actually think about things as being formal or informal is potentially, unclear. What constitutes formal? I mean, a lot of these lenders that I look at here use contracts, for instance, went to courts. These are formal players in a formal market. That changes a little bit after 1937, but to a large extent. So what constitutes formal and informal and how they vacillate between them is something that economic history, but I think economics and other disciplines more generally maybe haven't thought a lot about. The second set of comments are, very insightful. Thank you very much. And, of course, I always knew that the book would be somewhat provocative in that sense. And I appreciate the debate that exists. I mean, I think it's for the students out there, one of the exciting parts of economic history is that history is open to interpretation. And, this is how we interpret things with the concepts and evidence that we have is free for anybody to do and in different ways. And I think that's what's the exciting part of it. I will say that I think one of the big parts of my book was a lot of the literature that you mentioned, which is we have a lot of literature that tries to explain market power, and we don't have a lot that tries to explain risk and enforcement. And I think that was one of the big entry points for me, was to say, well, I think that's an important discussion that needs to come in. So your final point about trying to find bridges between these different interpretations, I think we also need to start by thinking about what the interpretations are, and then try to find the bridge between them. And I think that's sort of the starting point for me very much as well. And I won't respond to every single comment there because I think they're all super, super useful, but I'll also open it up to the floor. So yeah, maybe I hand it back to you, Prachi.
Yeah, thanks, Maanik. I would like to request the participants, if anyone's got any questions or comments, remarks, then you can unmute yourself or maybe put it in the chat box. We can read it out and then maybe Maanik can take it forward.
Hi, Prachi. I think there's a question in the chat box if you can see that. I don't know if only I can see it.
Oh, yes, yes, there's one. Maanik, can you see it? It's seems like a rather provocative question. Should I read it out loud or is it visible to him?
No, I can see it. Yeah, I mean, I'm a historian by training, so for me, looking at the past is very much what I do. I'm motivated by what happened in the past. My book doesn't really go a lot into the present, I'll be honest. It talks a bit about credit after 1960 in a very broad stroke sense. But for me, the question is about trying to understand the sources of underdevelopment in British India and early post-colonial India. So that's really where my expertise lies.
There's Pranav, I think, who's wanting to ask a question.
Yeah.
You can unmute yourself and ask Pranav.
Yes, good afternoon, sir. Sir, I agree with what Nayan sir asked, because what I personally feel, and I do agree with the answer that you have given, that there are limited sources and the archives are not open. But what I personally believe, I do not have a very solid background in history as per se, but as per the understanding, after the 1858 Government of India Act, all the acts that came in were more or less, basic tweaks in what they brought in. And if we look at the laws that are there, there in India right now, governing the state, more or less the little tweaks in the older versions of what the Britishers brought in to administer the state. Sir, what I need to ask in this regard is, why do we not also consider the era of rule, where the were levied by the me on the people? Why are we not? Uh, I have not read the book yet, so I do not know whether you have dwelled into it in the book. So I'm really sorry for it. But yeah, I mean, have you covered it, or what is your view as to the state imposing taxes on the farmers, wherein you already mentioned how most of the farmers were dependent on, or all of the agriculture that was being done at that time was dependent on rain? That being the question. Thank you.
No, that's a good question. I mean, I do talk a little bit about land taxation in my book. I mean, you can't really talk about British India and not talk about land taxation. I mean, that's absolutely right. Essentially, one of the problems with taxing anywhere in the world in the 19th century, early 20th century, is the ability to tax individuals becomes very, very hard. So if you tax land, it becomes very easy for the state, that is, to tax. The problem is if you have a fixed tax on land, it doesn't adjust for the volatility in output or volatility in earning. And it doesn't adjust for, potential dips into deprivation or not. And so that becomes, of course, a problem for everybody in colonial India and becomes very contested for good reason. In terms of what this means for the farmer, of course, it means that they don't often meet their tax bills, and that's something that happens. And you see a similar sort of strain in the early kind of part of British period of crown rule, so that is 1860s, 1870s, you start to see a lot of punishing of people who are not paying their land taxes. Over time, that declines. There's you start to see tax holidays. The Great Depression, actually, the government just paused tax collections for 2 years. And a part of it's not necessarily charity, it's more just a fear of tensions, riots in the countryside. That was what was driving a lot of that policy response. But also the sources of government revenue in British India start to change. In the mid 19th century, a lot of the government revenue comes from land taxation. By the 1930s, land taxation constitutes a very small part of government revenue. A lot of public revenue comes from railway receipts primarily, and various other forms, kind of, trade taxation, other sorts of things. Actually, trade tax wasn't that tax, but a lot of it comes from railway receipts and sort of indirect forms of taxation. So the land tax as an instrument actually starts to get a lot weaker over the course of British rule.
Thank you, sir.
So any
I
other
had
questions?
I had one more, which is, since you bring in this question of the spatial question, let's say, I mean the question of geography or specifically climate, and how credit markets operate differently in arid and wet regions and so on, and how both colonial as well as post-colonial nation states have not have inadequately dealt with it. So would an alternative arrangement, does the argument go towards that end, that an alternative arrangement would have to figure in this question of the climate into its mechanisms? I mean, is that where we are? Is that something you're trying to suggest? And then, for example, I mean, the implications for it today with entire question of climate change and so on.
I mean, you're asking a question that I think is, where my work has gone since the book, to be honest, which is how do you deal with this problem of risk, right? So what we kind of know now is that a lot of where irrigation was built in British India, you see far less of a problem. So a lot of this becomes an insurance against climate risk. That's something that we know. After independence, after India gains independence, you see huge expansion in irrigation investments. That's canals, that's dams, and then later groundwater extraction. But of course, this has now become a big problem for climate change because it's led to depletion of our aquifers. It's furthered climate change in a really problematic way. So there's been some work recently to suggest that this problem of rural underdevelopment and climate change is linked in a very kind of contestable way. If you read political ecologists, they will talk a lot about kind of, again, class struggles in that context. Economists and economic historians will talk a little bit about kind of the trade-offs between irrigation investment and unsustainability in the long run. So that's a field that really we need to understand a little bit more. I mean, one of the things that the book does is to highlight a lot of the problems. It doesn't talk a lot about the solutions because it's not a policy book necessarily. But if we were to look into those solutions, and a lot of where the solutions came in the kind of late 20th century, that has a kind of complicated relationship with climate change for sure. Does that answer your question? Yeah.
Was someone speaking? I can't see who was speaking. Yeah, I guess does anyone else have any questions, or should we call it a day? Yeah, I guess so. Maybe we'll conclude the session. Thanks a lot, Maanik, for your time, for your very wonderful insights, and a very, very insightful book that a lot of us need to sort of go back and take a detailed look at it, go through all of it, and hopefully the students would come up later with questions and remarks in classes or maybe over email or any such thing. So thanks again. Thank you for very graciously agreeing to our invitation and for this very, very wonderful session. And thank you everyone for joining in and being such patient listeners. And also in case of any remarks, we'd always be open to those. So thanks a lot. Thank you, Maanik, and thank you everyone. Thank you, Nayan, and thank you, Dr. Rohit.
Thank you.
For being such
Thank you.
brilliant discussants. Thank you.
Thank you.
Thank you. Thank you.
Thank you.